Stratton Oakmont, the company responsible for one of the major stock manipulation and fraud schemes during the early 1990s, was founded in 1989 by Jordan Belfort and Danny Porush in Lake Success, New York. The firm initially operated as a franchise of Stratton Securities before splitting off and embarking on its notorious journey of aggressive and unethical practices, especially in dealing with overvalued penny stocks. At that time, penny stocks were being sold with a 50% commission. If a broker sold $5,000 worth of stock, he earned $2,500. You might now be wondering who would buy such risky stocks with such high commissions.
Honestly, mostly schmucks. Postmen, there's always postmen.
Belfort created a special script that outlined a selling strategy for his brokers, which was essentially, first, sell blue chips with a 1% commission to earn the customer's trust and make him some money. Then sell the risky penny stocks, and you will earn a lot of money. This strategy was working perfectly, and Stratton experienced rapid development. In 1991, Forbes wrote an article that was supposed to make fun of Belfort's previous business, a seafood delivery company that went bankrupt, but drastically increased Stratton's recognition, client base, and encouraged more talented brokers to join. Commissions from penny stocks weren't enough for Porush and Belfort, so they started using typical pump and dump schemes. Since the firm was not only engaged in high-pressure sales tactics but also controlled the prices and trading volumes of the stocks they manipulated, they profited immensely from market manipulation. Internally, Stratton Oakmont was known for its lavish and hedonistic culture, highlighted by extravagant parties and widespread substance abuse. Under the charismatic yet manipulative leadership of Jordan Belfort, the firm's employees were encouraged to push sales to the limit, often crossing ethical boundaries. This culture of excess was believed to fuel the aggressive sales tactics that were the hallmark of Stratton Oakmont's business operations. After a few years of the company's operation, they finally received permission to conduct initial public offerings, IPOs, and that's when money started growing on trees. With all these ingredients, talented, aggressive brokers, pump and dump scheme experience, the ability to conduct IPOs, capital earned from penny stocks, and no moral boundaries, Jordan Belfort created a behemoth among frauds. In simple terms, it worked like this. Company XXX wants to go public, so it approaches Stratton Oakmont to conduct its IPO. Belfort's company is happy to help, and Belfort's and Porush's money mules subscribe to shares of that company. On IPO day, Stratton's brokers start to sell a small amount of shares and inflate stock prices, then sell Belfort's and Porush's money mules holdings at peak prices, causing the stocks to crash and leaving regular investors with substantial losses. After this procedure, Jordan and Danny launder the dirty cash in Switzerland. The largest fraud of this type took place in 1993, when Stratton conducted the IPO of Madden Shoes. That day, Belfort earned $12.5 million in just the first 3 minutes of trading, and tens of millions in the following hours.
$22 million in 3 fucking hours!
However, the firm's blatant disregard for financial regulations eventually caught the attention of the Financial Industry Regulatory Authority, formerly the National Association of Securities Dealers, NASD, and the Securities and Exchange Commission, SEC. In 1996, after extensive investigations, Stratton Oakmont was expelled from NASD and forced to shut down. The fallout from their operations led to legal consequences for the founders. Jordan Belfort, for instance, was indicted for securities fraud and money laundering in 1999. He ended up serving 22 months of a 4-year sentence and was ordered to pay back $110.4 million to the investors he had defrauded. The story of Stratton Oakmont gained further notoriety through Jordan Belfort's memoir, The Wolf of Wall Street, and its film adaptation directed by Martin Scorsese. These portrayals highlighted the unbridled greed and corruption within certain sectors of the financial industry, serving as a cautionary tale about the dangers of financial deregulation and the ethical lapses that can ensue when ambition goes unchecked in the stock market.